Let's begin on the title slide. What are blue chip stocks? Building enduring wealth through proven market leaders. Before we go anywhere, pause and think. When markets shake, what do you usually do? Panic, freeze, or chase the next hot thing? This deck is here to solve that tension. It's about replacing anxiety with structure. The quote on this slide, "In the long run, the market is a weighing machine," sets the tone. Short-term noise votes emotionally, long-term value weighs reality. If you want something steady to follow along later, remember the PDF handout is linked in the description below. As we move to the agenda slide, notice the path laid out: definition, reasons for endurance, benefits, trade-offs, identification, and real examples. This order matters. Many people mess up by jumping straight to stock picking. This agenda slows you down on purpose. Ask yourself, which of these steps do you usually skip? That skipped step is often where mistakes start. Turning to the slide on what is a blue chip stock. The first point says large, established, financially strong companies. In plain terms, these are businesses that already survive storms. Think Apple or Coca-Cola. The second point, long operating history, filters out hype. If a company hasn't lived through recessions, how do you know how it behaves under pressure? The third point, consistent earnings and dividends, answers why these stocks are here: reliability. And the final point, often part of major indices, signals peer validation. Ask yourself, are you buying stories or are you buying proof? Now the slide on why blue chips endure. This builds directly on the definition. First bullet, economic moats protect profits. That's a fancy term, but it just means competitors can't easily steal customers. Brands, patents, scale. Second bullet, scale absorbs shocks. When revenue dips in one area, they don't collapse. Third bullet, adaptation beats speculation. This connects to the intelligent investor. Quality businesses change without losing their core. Here's the question. Are you expecting your investments to adapt for you, or are you hoping luck adapts to you? Next, core characteristics. Strong balance sheets. That's financial breathing room. Low to moderate debt means fewer sleepless nights during downturns. Industry leadership shows pricing power. And reliable dividends prove cash flow is real, not theoretical. This is where many investors mess up. They admire growth, but ignore balance sheets. Ask yourself, if revenues stopped tomorrow, would this company survive? That one question fixes a lot of bad decisions. On the benefits slide, notice the emotional shift. Lower volatility means fewer panic reactions. Predictable income means your money works even when you're not watching charts. Long-term capital growth rewards patience. And peace of mind during downturns, that's underrated. Many quit investing not because of math, but because of stress. So ask yourself, is your strategy built to survive your emotions? Now the compounding effect. This slide explains how blue chips quietly win. Reinvested dividends do the heavy lifting. 7 to 10% over decades doesn't sound exciting until time multiplies it. This ties back to Philip Fisher's idea. Value reveals itself slowly. Here's a gut check. Are you bored too early? Because boredom is often the signal you're doing something right. Then we face the trade-offs. Slower growth than small caps, true. Can become overvalued, also true. Disruption still happens. This slide exists so you don't romanticize blue chips. Stability doesn't mean immunity. The mistake here is thinking safe means can't fail. The fix? Review, not blind faith. Ask yourself, do you check your investments or do you avoid them when things feel uncomfortable? Moving to how to spot a blue chip. Market cap over 10 billion filters scale. 10 plus years of profits filters resilience. Consistent dividends filter honesty. Brand dominance filters staying power. This echoes Peter Lynch, know what you own. Many people outsource thinking to headlines. This slide pulls it back to basics. Question for you. Could you explain why you own each stock in one sentence? If not, that's your signal. On real-world proof, Coca-Cola's decades of dividends show endurance. Microsoft's reinvention shows adaptability. Johnson & Johnson's diversification shows resilience. These examples connect everything so far: moats, scale, patience. They didn't avoid problems, they outlasted them. Ask yourself, are you choosing companies built to survive change, or ones hoping change doesn't arrive? Now to try this slide, this is where action replaces theory. Start with a 20 to 40% allocation. Not everything. just enough to anchor you. Reinvest dividends automatically so discipline beats mood. Hold for 5+ years to let compounding breathe. Review twice a year, no obsession. Most people mess up by either overtrading or ignoring entirely. This middle ground fixes both. Which side do you lean toward? Finally, the closing slide, your next move. The question here is simple but uncomfortable. What would change if your portfolio prioritized endurance? The quote reminds you, know what you own and why. This is also where I'll nudge you. If this way of thinking brought clarity, subscribe to the channel. That's how you stay grounded instead of reactive. And once again, grab the PDF handout linked in the description so this doesn't fade after the video ends. Before you go, one last thought. Are you trying to beat the market, or are you trying to stay in the game long enough to let it work for you?